Morning, everyone. We'll just jump right into the slides, although I do want to spend 30 seconds on the first slide, which normally I wouldn't do. And I just want to point out that the title of this talks about, every partnership and LLC operating agreement needing to be amended. When my managing partner, who's also a tax guy, first mentioned these rules, he made a statement along the lines of, we're going to have to amend all our agreements. And I thought, well, that sounds typical, overreaction to legislative changes. And the more I started reading these rules and thinking about the implications of the rules, the more I became, convinced that these rules really are going to require every LLC, every partnership to amend their agreement in some way, and we're going to talk about some of those amendments, and certainly every LLC or partnership won't have to make all of these changes, but I think these will have to be taken into account in some way by every partnership and every LLC. So going to the next slide, we already talked about me. Okay, so these new audit rules came into effect in November of last year, and so these are law. These aren't temporary regs or proposed or anything like this. These are code sections in the Internal Revenue Code. They are not mandatory until 2018, and that presents a problem for those of us that are lawyers and accountants. It's hard to get people focused on a change that doesn't happen until 2018, especially when these were passed in 2015, and I'm still having a hard time getting people to really start thinking about this. These changes will require a lot of thought and a lot of discussion amongst partners and members in LLCs. I certainly don't think that, at least beginning next year, it's too early to start focusing on these changes. The code sections that we'll be talking about are in 6221 through 6234 right now. Again, these are provisions in the Internal Revenue Code, not regulations, not proposed. One point I want to make is that partnerships can elect to be subject to these rules now, and that's worth mentioning because, as we'll see, partnerships that are subject to these rules, whether they be in 2018 or they make the election to be effective now, it's the partnership that will pay the liability. And so if I am buying a partnership interest this year or next year, even before the rules take effect, I need to be concerned and just make sure as part of my due diligence that the partnership I'm buying into has not elected to be taxed under these rules now. Otherwise, I might find myself buying into a partnership that's going to be assessed an amount on audit that relates to a year when I wasn't a partner. So maybe the partnership took an aggressive deduction 2 years ago. If that's being audited this year, I buy in, and the partnership has to pay the tax, which is what the regime provides, as we'll see. I'm going to essentially be on the hook for that amount since I just paid into the partnership. So we'll talk more about that concept later. But the point here is that anybody buying into a partnership, or if you have a client buying into a partnership now, you really have to make sure that that partnership is not elected to have the rules apply prior to the 2018 effective date. So because these changes are so significant, as I mentioned, we really need to start talking about them now. I think this is one of the bigger changes that's happened in the partnership area, and these aren't technical partnership tax issues or accounting issues, but they are fairly complicated, even though they are basically procedural in nature. Why did these rules come into place? Some basic background. As you all know, businesses are more and more often being formed as partnerships and really LLCs, taxes partnerships. Obviously, if I say the word LLC, I mean an LLC taxed as a partnership for purposes of this presentation. And because more and more businesses are being formed as LLCs, and because the IRS right now, under their current audit procedures, really has to assess and collect any deficiencies from the individual partners after a partnership audit, enforcement has been very difficult. And in particular, partnerships with tiers of partnership owners are really difficult to audit, and assess. I do work for a pretty significant number of LLCs that have very complex capital structures, tiers of partners upon tiers, and these entities basically think of themselves as almost audit-proof, because, yeah, the IRS can come in and audit the partnership, but assessing or, going after each of those partners and then the partners of the partners for any resulting assessment as a result of the audit is almost impossible. And there was a GAO report, it goes back to 2014, but I'm sure it's still applicable, that less than 1% of large partnerships were audited compared to 27.1% of comparable large corporations. And that just makes sense. If you're an IRS auditor and you can audit a corporation and have the corporation cut a check, of course you're going to do that as opposed to audit a partnership and go after 60, 100, 300 partners to get your money after the assessment. So that's why these rules came into place, is the extremely difficult position the IRS is in terms of not in the audit of the partnership, but in collecting the assessment. So these new rules are going to allow the IRS in most cases, and in most cases means, with the exceptions that we'll talk about, to assess the additional tax against the partnership itself. So these rules will eliminate the need for the IRS to proceed against the individual partners or with partnerships with multiple tiers, the partners of the partners. And the second bullet point on this slide 5 is really the most important point, and the thing about these rules that makes this very difficult to say, well, the partnership agreement doesn't need to be amended. Since the assessment is going to be made against the partnership in the year that the audit is concluded, okay, and the payments made from the partnership assets in that year, the assessment's really getting paid by the partner who are the partners in the year that the audit is concluded, right? I mean, these partners aren't paying the audit assessment out of their pocket, but the partnership is paying that. And again, in my example, where I just bought into this partnership this year, and the audit happens this year, even though it relates to a year prior to when I bought in, I'm not coming out of pocket for that assessment, but the partnership I just put, my $1 million into just had a $1 million assessment, and I've got a third of that or whatever, and so that's essentially that's my money that's going to be flowing out to the IRS. So that's, under the current rules, obviously, if the partnership gets audited for 2014, it's the partners in 2014 that, or the partners who were partners in 2014 that end up paying the tax. So that's the biggest issue, I think, from a practical standpoint with these rules. I'm going to skip over a lot of this. I usually do this in a presentation where there's a little bit more time. I don't think this is critical information, but I do think when you're explaining to clients, what the new rules are, or if it's your business thinking about what the new rules are, a question that always comes up is, well, what are the current rules? How is this different than what we're under right now? And basically, under the current rules, you've got 3 audit regimes. You've got a different set of rules for electing large partnerships, partnerships with more than 10 partners, and partnerships with fewer than 10 partners, or partnerships with fewer than 10 partners that have pass-through entities as partners. So we'll talk a little bit about each of these, but not a whole lot of time. So with electing large partnerships, the audit's done at the partnership level, and then the adjustments reflected on the partner's current year return. So no amended return has to be done. Basically, the partners do not have a lot of rights with respect to the audits. The bottom line for ELPs is there are very few ELPs. I mean, there are literally only, there's not that many partnerships that qualify, and even fewer elect this status. So it's almost a historical reference only at this point. Partnerships with